Today, folks, we're diving into the highest yielding Canadian dividend stocks, starting with the favorite ETFs that pay monthly, super high yielding. We'll get into the individual stocks that are suppressed but are mega cap Canadian giants with yields of up to damn near 8%. And then we're going to talk about 3 Canadian dividend stocks that have been crushing it to the frigging moon on a growth trajectory just in the beginning of this year. And if that is a conversation you appreciate, damn it, go down there and consider hitting that like button. As always, we should really start with the broader ETFs, because if I was heading into retirement and, like people like my parents, these are the only ETFs I would truly focus on, because combined they yield very high dividends and they pay them monthly. So we'll talk about that with VDY and XEI. XEI over the 5-year capital gain performance is trailing VDY pretty substantially, but as we'll see, VDY is a bit more concentrated. Year to date, also VDY is only down 0.44%, where XEI is down about 1.45%. But let's just take a look at the VDY first and foremost here, which is Vanguard's FTSE Canadian High Dividend Yield ETF, yielding about 4.74%. You get rid of the management fee of 0.2, you're looking about basically 4.54%. Let's see if the weightings have changed coming into this year, because there has been some new net additions to the top holdings, because Manulife, the financial sector when it comes to insurance has been exploding so far this year. So Manulife is now sitting within the actual top 10. I do remember Bell was in the top 10 list, but because these are more passively weighted, we're seeing the ones that are getting a little more suppressed move their way toward the bottom in VDY. So we can see Royal Bank, Toronto Dominion still hold the top 2 spots. Toronto Dominion's losing its higher weighting because, again, it is shrinking in market cap. You still have Enbridge, Canadian Natural Resources, some of the banks like BMO, Bank of Nova Scotia sitting a little bit lower weighted. And let's just see from the sector allocations if anything's changed. Financials still make up a huge percentage at 56%, energy at 27%, telecoms at 6%, utilities at 5%, and then everything else from there below. VDY has actually been paying out higher dividends because, as we know, many of these companies have increased their dividends as of Q4 earnings. So yeah, we're seeing about a 19-cent monthly payout for the beginning of January here, which is pretty nice to see, which is actually higher than a lot of the January payouts. We go back to 2023 here, we can see we're getting about 17 cents. 2022, January was not that appealing at around 13, 16 cents. So that's where that sits in comparable to XEI right now, which, this is same exact expense ratio, same beautiful ETF. This one, however, is yielding 5.8%. You minus the 0.2 management fee, you're looking at about 5.6. But if you contrast both of these ETFs together, you're damn near equaling a perfect 5% yield if you just bought both of these, and you're probably getting a lot more diversity, as we'll see, because this one doesn't weight the companies as concentratedly. This one's just kind of diversifying it pretty extensively, with the top weighting being 5%, which is Suncor Energy. You got Royal Bank in second, C&Q, TC Energy, Toronto Dominion, Enbridge. You're seeing some of the telcos like Telus and Bell at the top 10 list here, but again, all of these aren't much more than 4.5 to 5%. We take a look at the exposure rating. Financials are 31%, energy at 30%, utilities at 16%, and communications at 10%. So this one is paying a higher yield. It's much better diversified, but honestly, I really love both of these ETFs. If we take a look at the dividends here, we're talking about 12 cents coming into February, January. I mean, we're starting to see that increase from these companies paying higher dividends. So again, combine that, I don't think you could ask for better exposure to the Canadian economy. This is the safest way and the easiest way to cost average into getting monthly cash flow if that is what you're after. But if you're looking at the individual stocks and you want to collect and kind of inch out higher yields, obviously you're going to be looking at mega caps that are currently suppressed, and a lot of these are being suppressed because of the higher interest rate environment, and that is going to continue to remain true probably for most of this year. And you have to be patient if you're cost averaging into these, because basically over the last 10 years, we've lost pretty much all the capital gains since 2015, literally over the last decade, out of, unfortunately, Bell. And a lot of this has to do with interest payments and the continued suppression through this kind of semi-recessionary environment. But now we've got this blessing of almost an 8% yield that is sustainable and is likely going to increase, as they do have some plans for dividend increases this year. So your full rate of return will come from the dividend until we start seeing some, higher return out of the interest payments, because these infrastructure companies are loaded with debt. Telus paying currently 6.31%. Telus also not nearly as bad off. It did wipe out a huge percentage from the all-time high of about 30%, but it's still sitting above its 5-year high. So this has always been one of my favorite telecoms, but you're not getting nearly as high of a starting yield today. And then we're going to switch to the financial sector, which is going to be the utmost fascinating. We're going to get bank earnings coming in the next week. Bank of Nova Scotia is posting tomorrow morning. I will be doing a video on it. Consider subscribing. And Bank of Nova Scotia is like these banks in general, they have this kind of tailwind of mortgages coming up for renewal this year. I'm going to do some math and take a look to see how many come up this year, because obviously those mortgages are going to come at a higher interest rate market, and it's going to lower the credit quality of those mortgages, meaning these banks have to put loan loss provisions aside. But the neat thing about loan loss provisions that have currently been crushing these companies, because those are losses they can't add to the bottom line, is if those loans do not deteriorate and go into default, the bank can actually put those back on their balance sheet. So that could be an interesting tailwind if the market survives this higher interest rate cycle. But again, keep in mind, I think more than half of mortgages aren't going to be coming due till I think 2025, 2026. So long as we start cutting interest rates, I don't think the market will be hit as hard. But this is currently yielding 6.67%. TD, the next highest yielder here at 5.08%. I think actually CM is probably the next highest, but this is like one of these mega cap, second largest companies in Canada. To get a 5% yield is pretty astounding. Let's just take a look at Canadian Imperial, currently yielding 5.88, and is actually still trading down 3% year to date. Now, finally, in the realm of insurance, financial, asset management, we do have Power Corporation, which is actually up 3% year to date, 5.36% starting yield. This thing owns Wealthsimple and has been a very slow and steady grind up since the lows of 2022. This thing has been offering great returns, traded at a great value, gives you great diversity. And yeah, I still think it's a good buying opportunity here. We've been seeing things like Manulife and the insurance players get absolutely sent to the moon. For Canadian markets, especially in this boring sector, to see these kind of gains just in the beginning of the year is unheard of, considering if you zoom out, I mean, these companies largely didn't do anything for the last decade in their stock price. Still yielding 4.88% and now making its way into some of the top holdings of these ETFs like VDY. You've also got Sunlife up 8% with a 4.22% starting yield. Again, hitting, it's pretty much historical highs. Nice to see. Enbridge, another company that's getting really suppressed here through dilution. They've been doing acquisitions and trying to build the company out, hitting lows that it really hasn't seen basically in 5 years. This one hasn't really grown from a stock standpoint, but when you're talking about an 8% yield to get the largest pipeline infrastructure company globally that spans all the way from Canada down to like Texas, it's a pretty like lifeblood importance utility on humanity here. So I don't think you're going to do too wrong if you're just looking for dividends buying this. In contrast, a lot of people do like Fortis, some of the utilities, and this one's been getting hit also fairly hard. It's kind of wiped out almost 5 years worth of gains. It's trading down about 18% with a 4.5% starting yield. A lot of people love this one as a steady eddy. The utility sector, I still think, is a resilient place to get beautiful passive income, because you look at something like Hydro One, and I really don't get the value of this company because they just don't grow that much right now, but they're still trading up, and because it's a government-run entity, I'm presuming that's why there's so much stability. And you'd have to do some deep diving because, like I said, when I looked at this, I just wasn't like totally impressed with it. So, I mean, you take a look at the revenues, up 7.84 billion versus 7.78 billion this time last year. It's not like explosive growth. They kept their earnings up to $1.81 versus $1.75. Year over year for the 3-month end, it's exactly the same. So I'm really kind of confused as to what has been driving a lot of this growth for this company. I'd have to do some deep dive. Maybe they're doing some share buybacks. I'm not exactly sure, but it's been a huge outlier along with something like Waste Connections. These are the utmost boring companies on the planet. I mean, Hydro One is literally just a transmission line focused company. They just deliver the hydro. They're not as much into producing it. Waste Connections, as we know, is one of the largest companies in Canada that deals with your waste. And this company is falling in line with Apple. And when I mean Apple, I'm talking about the margin expansion. This company currently yields about 0.67%. I should point out Hydro One's almost yielding 3%. But Waste Connections here, if you take a look at their last earnings, basically their net income was up 16.4%. Revenue was up almost 9%. I mean, their adjusted EBITDA was up 200 basis points with margins of 32.2%. Apple has margins of like 30%. So for a waste management company to be pulling in 30% margins is just absolutely astounding. I mean, a lot of the waste companies, I don't know what they're doing with their businesses, but I'm just blown away by the growth out of such a fascinatingly boring industry. I mean, you take a look from 2018, this thing's up 154%, probably falling in line more with tech company growth. And then finally, we also have things like Canadian National Railway. These things also didn't have that great of Q4 earnings, but are now rallying up, and they're currently yielding around 1.9%. So these are more of your growth-oriented Canadian companies, but still just fascinating to see what the Canadian landscape has been doing. And I want to pass the question off to you. Are you guys buying any of these? I'd just love to know what you think in that comment section below.